All right, let's get into it. We're talking about something every single Canadian thinks about, how to keep a little more of your own hard-earned money. In this explainer, we're going to dive into the world of tax deductions. These are the totally legal, super powerful tools you can use to shrink your tax bill.
So here's the million-dollar question, right? How do you actually, legally, make that pile of income that the government gets to tax smaller? Well, it's not some kind of secret trick. It's all about understanding one really simple, really powerful concept.
And here it is, the tax deduction. Okay, think of it like this. Your total income for the year is a giant pizza. Now, before the CRA comes along to take its slice, it actually lets you pull a few pieces off the top to cover the costs of making that pizza. Those pieces you pull off, those are your deductions. And because they make the whole pizza smaller, the CRA's slice automatically gets smaller too. That's the whole game, right there. So first up, let's talk deductions for all you employees out there. It doesn't matter if you're on a salary or earning commissions, there are some really key ways you can lower your taxable income from the get-go. Now this slide is huge because it clears up something that confuses so many people. You've got the big three savings accounts, right? But look at that first row. That's the magic number. Your contributions to your RRSP and the new First Home Savings Account, the FHSA, yes, they are tax deductible. They shrink your income for the year. But your TFSA? Nope, that's tax-free on the growth, not on the money you put in. And you gotta watch those deadlines. You get a nice 60-day cushion into the new year for your RSP, but that FHSA is a hard stop on December 31st.
Okay, what if you're paying for things for your job out of your own pocket and your boss isn't paying you back? Well, you might be able to deduct them. But, and this is a big but, you have to follow the process. Step 1 is the absolute key that unlocks the store. You must get a signed Form T-2200 from your employer. It's their official sign-off that says, yep, they had to pay for this stuff to do their job. Once you have that, you just track your expenses and file Form T-777. Easy as 1, 2, 3.
So what kind of expenses are we even talking about? Well, here's some of the big ones. A piece of your home, utility and internet bills if you work from home, office supplies, even some of your car costs. And here's a little kicker. If you earn commissions, the list of what you can claim actually gets longer. You can start adding things like advertising, and a big one, half of your meals and entertainment expenses when you're wooing clients.
Hey, did you move for a new job last year? If so, do not miss this deduction. You can claim your moving expenses, but here's the deal. You have to pass the 40-kilometer rule. Basically, your new house has to be at least 40 clicks closer to your new job than your old place was. If you check that box, you'll use Form T1M to claim everything from the movers to gas and even a hotel stay along the way.
All right, for all the parents listening, this is one of the biggest deductions you can get. We're talking childcare. If you pay for daycare, a nanny, after-school programs, even summer camp so that you can work or go to school, you can deduct those costs. And these limits are no joke, up to $8,000 for a kid under 6. And get this, those limits are per child. You'll claim it all on Form T-778.
Okay, let's switch gears and talk to our next group, all of you with a side hustle, a small business, or maybe a rental property. If you're earning income that doesn't come from a regular paycheck, well, your world of potential deductions just got a whole lot bigger. You know, the logic is exactly the same here. You get to deduct these legitimate costs of earning that income. And for businesses and rentals, the list of expenses is pretty long. You're looking at things like advertising, insurance, and paying your accountant. Now, for landlords, here's a key one. You can deduct the interest part of your mortgage payment, but not the principal part that pays down the loan. Get familiar with Form T-2125 for business and T-776 for your rental. Now, this is a distinction that is absolutely critical, and it trips up a ton of people. You have to know the difference between a current expense and a capital expense. So think of it like this. A current expense is a repair. You fix a leaky pipe, you repaint a wall, you get to deduct 100% of that cost this year. Done. A capital expense, though, is an improvement. You add a whole new bathroom, you finish the basement. That adds lasting value, so you can't deduct it all at once. Instead, it gets added to the official cost of your property, which actually helps you out by lowering your capital gain when you eventually sell. And here's a massive pro tip for you landlords. You might hear about this thing called depreciation, or capital cost allowance, on your rental building. It lets you deduct a tiny percentage of the building's value each year. Sounds amazing, right? But be so careful. There's this rule called recapture, and it means that when you sell the place, you have to add up all the depreciation you've ever claimed over the years and report it as income all in one shot. For most everyday landlords, it's like setting a future tax bomb that's just not worth it.
So what happens if your business or your rental actually lost money? You might be tempted to just forget about it, right? Nope. Don't you dare. You have to report that loss. Why? Because a reported loss is an asset. It's valuable. You can use it to wipe out other taxable income you have, maybe from your day job. And if you still have some loss left over, you can carry it forward to kill taxes in future years when you are making a profit. Never, ever let a loss go to waste.
Okay, our final category. Let's talk about the money that your money is making, your investments. Because it's not just about what you earn from the market, it's about what you actually get to keep after taxes.
So let's walk through a quick little story here. Imagine in 2025, you sell a stock and, ouch, you take a $10,000 capital loss. It happens. Then, the very next year, you sell another stock, and hey, you score a $5,000 capital gain. Awesome.
So you have to pay capital gains tax on that $5,000 profit from 2026, right? I mean, that seems pretty straightforward. Well, you might think so, but not necessarily. There's an incredibly powerful tool you might be forgetting about.
And this right here gets to the heart of a brilliant strategy for investors. You can use that $10,000 loss from last year to completely wipe out the $5,000 gain from this year. Your tax bill on that gain becomes zero. But here is the catch, and it's a big one. The CRA keeps track of your capital losses, but they will not apply them for you. You have to be the one to actively claim your net capital losses of other years on your tax return to make it happen.
So, if we boil all of this down, from work expenses to rental properties to investment losses, it all hinges on one simple, non-negotiable habit: the golden rule.
You have to track everything. That's it. Your records are your proof. Use an app. Use a simple spreadsheet. Snap photos of your receipts. For any business expense, just jot down the who, what, when, where, and why. And here's my favorite tip. Your notice of assessment from last year? That thing is a gold mine. It tells you exactly how much unused RRSP room you have and how much in capital losses you're carrying forward. It's basically your own personal tax treasure map. Okay, we've covered a ton of ground, but just knowing this stuff is only half the battle. So I'm going to leave you with this one question to think about. What is one expense, one number, or one piece of info that you're going to start tracking today that will make next year's tax season your best one yet?